Welcome to This Explainer. Over the last few decades, there's been this fascinating and honestly deeply concerning economic shift happening right under our noses. Back in the post war era, middle class wages and overall economic productivity basically grew together in near perfect harmony. But somewhere along the line, that correlation completely fractured. Today, we're unpacking a massive financial dilemma that millions of everyday folks are facing right now: why the middle class is getting poorer. If you've been feeling the squeeze lately, feeling like your paycheck just doesn't stretch nearly as far as it used to no matter how hard you try, well, you are absolutely not alone. There are some really profound structural reasons for this, and we're going to break down exactly how this wealth erosion works and how the entire economic landscape has completely changed. Working hard but still falling behind? Man, it is an exhausting reality. Imagine waking up every single morning, putting in those long, grueling hours, diligently paying your bills on time, and yet you still feel like you're stuck on a treadmill that's moving just a little bit too fast. And for millions of us, this isn't just a feeling, right? It's mathematical reality. When we look at recent data, real wages, which is really just a fancy way of saying wages adjusted for inflation, are often flatlining or even dropping for middle income earners. So think about it like this. Even if you get a standard 2 or 3% bump in your salary this year, if the real world cost of groceries, gas, and rent jumps by 5, 6, or 7%, you are literally taking a hidden pay cut year after year. The treadmill keeps speeding up, but your legs are moving at the exact same pace. Section 1. Forces against financial stability. The headwinds. Okay, let's dive into this. To understand why that treadmill is moving so fast, we really have to look at three major systemic forces that are essentially working against everyday families. First up, we've got rising costs. And we're not talking about discretionary spending here. We're talking about the absolute foundational pillars of middle-class life: housing, healthcare, and education. Over the last 20 years, the cost of these essentials has absolutely skyrocketed past standard inflation. Homeownership used to be the bedrock of middle-class wealth, right? But now it's increasingly gated by massive valuations and crazy interest rates. Second, changing technology. We are living through a period of hyper-acceleration. Automation and AI aren't just coming for repetitive manual labor anymore. They're actively disrupting cognitive and administrative jobs too. This rapid shift can devalue traditional skills almost overnight, which means workers are constantly stressed out, forced to adapt just to stay employable. And third, evolving job markets. The whole nature of the employer-employee contract has completely shifted. We've largely moved away from the era of guaranteed pensions and lifelong corporate loyalty into this gig-heavy, super specialized economy. The heavy lifting of financial risk, like planning for retirement or figuring out healthcare, has basically been dumped from the company right down onto the individual worker. So when you stack up those rising costs, the tech disruption, and the shifting labor risks, true financial stability becomes incredibly tough to hold on to. Section 2. How wealthy individuals build value. The contrast. While millions of people are fighting this uphill battle just to stay afloat, there's actually a completely different economic playbook being executed at the exact same time. See, the traditional middle-class model relies entirely on a salary. You trade your time and your labor directly for a paycheck. We call this linear income. It's a simple one-to-one exchange, but the catch is it comes with a hard ceiling because you only have 24 hours in a day. If you stop working, well, the money stops flying. But the wealthy? Their strategy contrasts this by focusing heavily on building assets. Instead of just relying on that single linear salary, they strategically divert their energy and resources into asset accumulation. This is all about decoupled or exponential growth. Assets are amazing because they have the unique ability to compound, generate their own yields, and grow in value entirely independently of how many hours you personally clock in at a desk. So, what are these assets? Well, the primary vehicles used to build that independent value usually fall into three distinct buckets: businesses, investments, and real estate. These are the true engines of wealth generation. First, building or owning equity in a business allows for massive scaling. The value of the company can grow way, way beyond the initial sweat equity you put into it. Then you have investments, things like stocks, bonds, or index funds. These harness the absolute mathematical magic of compound interest, where your money essentially goes to work to make even more money. And finally, real estate. Historically, this has acted as a powerful dual threat. It provides potential cash flow through rental income, while at the same time acting as one of the most reliable historical hedges against inflation. Think about it. As the cost of living goes up, which was that first major headwind we talked about, the value of hard assets like real estate usually rises right alongside it, protecting your purchasing power. People using this playbook aren't just working for money. They're acquiring entire systems that generate returns on autopilot. Section 3. Income versus assets. The mindset shift.
And that brings us to a really fundamental concept: financial resilience. We can define this as the ability to withstand economic challenges over time by building long-term value rather than just earning a salary. Now, don't get me wrong, earning a solid income is absolutely critical. It's the fuel you need to survive and fund your daily life. But the real magic happens when you shift your primary focus from solely maximizing your income to strategically converting pieces of that income into resilient assets. To be clear, adopting this strategy doesn't guarantee you'll be wealthy tomorrow. There are definitely no magical get-rich-quick shortcuts here. It takes time and serious discipline. But what it absolutely does is build a vital shock absorber for your life. Remember those headwinds we discussed? If new tech disrupts your specific industry, or if the job market forces you into a lower-paying role, having an investment portfolio or equity in real estate means your literal survival is no longer 100% tied to the whims of a single boss. Your accumulated assets provide a massive buffer, drastically reducing your vulnerability to all that economic turbulence.
So I want to leave you with this. Are you only earning income, or are you also building assets? Honestly, it might just be the most defining question for your entire financial future. Operating purely on a salary means you're always stuck playing defense against inflation and economic shifts. Earning an income pays your bills today, for sure, but strategically building assets, that is how you secure your tomorrow. It's the ultimate transition from just surviving the economy to actually participating in its growth. I want you to think deeply about how you can start shifting your own everyday mindset and habits toward accumulating that long-term independent value. Thank you so much for joining me for this explainer. Take a moment to really sit with that final question, and I'll catch you next time as we continue to unpack the fascinating systems that shape our world.